Members of the FOMC indicated that disinflation was expected to take longer than previously thought. That weighed on equities today. We'll discuss that, perhaps see NVIDIA's results, and take some of your questions today on Open Interest. Hello everybody, I'm Mike Coe. Welcome to Open Mic. If you have a question, be sure to subscribe so you can type your comment or question into the live chat and we will try to answer it. So, and I'm going to quote now, quote, participants discussed maintaining the current restrictive policy stance for longer should inflation not show signs of moving sustainably towards 2% or reducing policy restraint in the event of an unexpected weakening in labor market conditions. Various participants mentioned a willingness to tighten policy further should risks to inflation materialize in a way that such an action became appropriate. At the meeting, the FOMC decided to leave its benchmark lending rate unchanged at 5.25 to 5.5 for the sixth straight time and said there's been a, quote, lack of further progress in bringing inflation down in recent months. The net byproduct of this, of course, is that the market's hopes for a near-term rate cut were reduced at the very least, and we can see what the impact was on rates. So if we just take a quick peek here, I have the 2-year rate, Treasury rate, which ticked up a little over 4 bips today to 4.87 and change, and we can see that the 10-year also ticked up, not quite as much, so we saw a little bit more of an inversion to the yield curve. We are right now, I should point out, at a period where the inversion to the yield curve has remained in place now for quite some time. And I bring this up because an inverted yield curve has historically been associated with the potential for a recession. And I think that the concerns about a recession have really been downplayed for a significant portion of this year. And part of that's justifiable. Economic data has been coming in quite strong. We've seen decent growth numbers, and possibly more importantly, out of earnings from a lot of companies, we've been seeing very good results. And we're about to get, if we have not already gotten, the results from NVIDIA, which represents more than 5% of the S&P. And actually, my colleague, one of the producers for this live stream, Brad Holt, managed to forward me a note from Goldman Sachs earlier today. And Goldman's derivative strategy team specifically pointed out that they felt that S&P options were not sufficiently pricing in the possibility that NVIDIA's results could contribute to broader market volatility. Now, a quick point I would make about that, in their note, they were actually just referring to the last 4 quarters rather than to a much more extended period. Now, this makes some sense in the following way, which is that, of course, how much any given stock can influence the market is going to depend on a couple of things, including how large that constituent stock is as a part of the index. A lot of the appreciation, and actually why don't we just pull up a longer term chart of NVIDIA here. How much of an impact NVIDIA could potentially have on the market would, of course, in part be a function of how large a constituent of the index NVIDIA actually is. And we can see that as of today's closing price, it was about $950 a share. Right now, it represents a little over 5%, I think about 5.2% of the S&P. And we can see if we go back just 5 years, the stock was, $33. It was about 1/30th of its current price. So even if we thought that NVIDIA was a bellwether, its direct impact on the market overall was going to be considerably smaller because the larger a constituent is, the more weight it's going to have. And actually, let's see, did we get any results? I'm just going to, because they should be coming out any instant, so this should be kind of interesting if we get those results. Still not, I still have seen nothing, but hopefully somebody will get my ear as soon as those results post, because I believe that call should begin pretty soon. So the question we ought to be asking ourselves is, number one, is it possible that some of these larger stocks could contribute to an uptick in volatility for the market? I would argue that almost anything at this point could. And the reason I would say that is because volatility, as we talked about on Monday's live stream, implied volatility anyway, which is the price of options and how volatile the stock actually has been, is exceptionally low right now. Now, it was a little bit lower on Friday. In fact, Friday was the first time that the VIX closed below 12 since 2019. And even in all of 2019, again, this was something we talked about earlier, in all of 2019, I believe it closed below 12 on only 3 trading days. And those were the trading days that just preceded Thanksgiving in 2019. So things that have helped contribute to relatively low implied volatility and realized volatility so far is the fact that the economic data has arguably been better than I think a lot of people had anticipated, myself included, and also earnings from the biggest constituents of the S&P 500 have generally also been pretty good. The question we need to ask ourselves now, though, is, are those assumptions a bit too optimistic? I believe that they are, and actually, I have here a chart which I'm going to just drag over. This is from the St. Louis Federal Reserve. Their economic data is known as FRED. So they have this. I actually encourage you to go to this website. It's a tremendous resource. And you can get all kinds of interesting data and reports from it. This is probably a little bit difficult to see. I know that some people prefer to see the dark charts. This one is directly from Fred. You can see I'm right on their website. So, but this is a chart of consumer loans. And so this is incorporating revolving debt, including credit cards and things like that. And what it shows us is that consumer debt levels are at essentially all-time highs. Not essentially, they are at all-time highs. And this is after we had seen some accumulated savings. So consumer spending, of course, dropped during the pandemic. We would expect that. There were a lot of transfer payments during the pandemic. Similarly, we would expect that those two things would essentially improve the financial wherewithal of consumers. And as we've previously discussed, the U.S. economy is consumer-driven. We got results from Walmart last week. Those were generally pretty good. We saw 6% year-on-year growth. We talked about this a little bit. There was about a 40 basis point increase in prices, and they said that all else equal, that the inflation impact was actually very small. So most of that 6% growth did not come from that. They had a 1% boost just as a result of a longer reporting period. So there was an extra sales day in there as a function of the leap year. Effectively, if you adjust for that additional day and you adjust for inflation, year-on-year sales growth for Walmart was about 4.8%. So that spoke to in theory, that spoke to a relatively strong U.S. consumer. However, then we got results, and we talked a little bit about Target. And you may remember on Monday when we talked about Target's upcoming results, the thing that we discussed was the fact that they announced on Monday that they were going to aggressively cut prices on 5,000 products. And they had already done so on, I think, 1,500 at the time that announcement was made. And they gave as a justification for doing this the fact that they wanted to remain competitive. That was a quote. So one could only assume that the competitiveness that they were referring to at the time was Target's direct competition in most areas, which would be Walmart. So they talked about lowering costs on some grocery items. That was going to compress margins. We figured that it seemed like a very odd time for them to be announcing something like that, given that earnings were just around the corner. Lo and behold, the company did announce earnings, and the results were not good. And what we saw, and actually I might as well just pull a quick chart of that one up as well, was that they actually registered a sales decline. Now, a quick point I would like to make about them lowering prices. So one could assume, now it was traditionally the case that Target saw slightly larger margins. This was going back in history sometime now, so I'm going back 5 years or so. Traditionally, Target enjoyed slightly higher margins than Walmart did, but we did see a period when they had rising inventories. They had a couple other issues, and we saw that their margins declined to about 2.8% going back about 30 months or so. They had more recently gotten those margins to expand, once again, closer to 4%. If they're going to lower these prices, then we could expect that there would be some compression in margins. So it's not a great recipe. And actually that helps explain why, in part, Target's earnings multiple was so much cheaper. So in round numbers, Walmart was trading around 26 times earnings and Target was trading around 16 times earnings. That basically was suggesting that investors were forecasting that earnings would decline. And so I do expect that if they lower prices, that probably is going to lure some people in. I previously mentioned that I think Walmart's focus on grocery has been very important because it's non-discretionary, gets foot traffic into the stores on a recurring basis. Maybe they make some discretionary purchases, maybe not, but in order to get those sales, you need to have that foot traffic. Okay, so I understand I'm being told that NVIDIA did in fact report earnings. So let's just take a quick peek at what we got out of them. It looks like, okay, so the estimate was in round numbers, 565. Comparable number, 612. So let's see. It looks like the stock is trading a bit higher. Looks like it's going towards the upper end of the price range of the strangle swap that we previously discussed. Not going to crow and so that would, remember that the strangle swap we talked about on Monday was the, memory serves, the 850. It was the 850 1020. So they beat by 52 cents, beat on revenues, and they're guiding above consensus. So that's a real positive, and that probably is going to be good for the market. We want things to be good for the market because what I'm going to be suggesting in just a little bit is that perhaps we might want to just think strategically about pivoting from sort of the momentum-driven, top-down market approach to more of a bottom-up sort of value-driven approach. But, they're also going to be boosting their quarterly cash dividend. Looks like it's going up to 10 cents a share. Not that that really matters for a $1,000 stock, which is where we are right now from 4. What's this? We're getting a stock split as well? 10 for 1 stock split. Wow. Okay. So this is a big deal. Yeah, so that is a real positive. So looks like good results. This is important. I think this is going to help, give some measure of support to the market more generally. And I think that's good because it's going to give us an opportunity to pivot. And, my thinking about the pivot is that we should be pivoting probably more towards a value orientation. And my thinking about that is sort of predicated somewhat on my concerns that, number one, interest rates could indeed remain higher for longer. I just saw one forecast today, by the way. I think it was Jeffrey Gundlach who came out. He was, usually, as many of you viewers will probably know, I'm on CNBC from time to time. Actually, I'll be on Fast Money this coming Friday for the full hour if you want to tune in for that. But I think Jeffrey Gundlach was on Fox, if what I was reading in the news earlier was correct. I have a lot of respect for him. I think he's extremely thoughtful. And I think he was forecasting maybe one rate cut for the full year. So, this is a big result. I'm wondering what's going on with the, I should never turn this machine off. That one's the one that has my live quotes, and I have a bad habit of turning that one off. If somebody who is hearing me upstairs just wants to tell me what the futures are up to, because this one's a little bit delayed. And by the way, just for those of you watching, just because of a licensing issue, I'm actually going to be getting live quotes onto the live stream on this machine starting on, I think it's June 21st. So I apologize until June 21st. I have to fill out a bunch of licensing paperwork and some other stuff, but I should have live quotes on this machine by June 21st, so about 4 weeks. Okay, so with that said, I wanted to move to some questions that I got and I thought were kind of interesting. So let's just start with this one. I've been slowly building a long-term position in Pfizer by buying shares and writing monthly puts in the 27-ish range. Do you think this is a good strategy? That question comes to us from Steve Garcia. Okay, so a couple quick things about that, and probably consistent with the conversation we're having more generally. I'm assuming that one of the reasons you are looking at Pfizer is because you also, Steve, are looking to potentially pivot slightly towards more of a value orientation. Pfizer is not a particularly expensive stock, based on most sort of valuation multiples. In fact, actually, I think I can pull this up and we can just take a look at this together. I'll try to leave this up for just a little while because I realize that on a screen, especially if you're looking at this on a small screen, and maybe we can zoom into this a little bit, it's going to be a bit hard to read. I'm going to just use my cursor so that everybody can sort of see what it is that I'm pointing to. So the mean multiple for the group, and you can see this is a relatively small group that we're looking at here. It's Johnson & Johnson, Bristol Myers, Merck, AbbVie, and Lilly, is about 20 times forward earnings estimates is sort of the mean level. And you can see that Pfizer right now is trading around, actually slightly under 12 times their historical multiple. I think if I was looking at this group, and we are looking at it together, so as we look at this group, I would argue that there is a throwaway number in here, and that number that should be thrown away with respect to comps is, of course, Eli Lilly. So why do we want to throw out Eli Lilly? Eli Lilly is the player right now, along arguably with Novo Nordisk, which isn't on here, in the obesity and the diabetes space. So that's, as I've previously said and arguably joked, that is arguably the biggest opportunity for pharma, and therefore it's a huge growth opportunity. Most of these other companies don't have that kind of growth opportunity. In fact, with pharma companies, it's really important to remember that as they lose patents on existing drugs, they need to essentially add new ones. Pfizer had been working on some obesity drugs of their own. Some of those had been in trial. Those didn't turn out well. Some of those things actually got canceled. So those were not showing significant promise. And presumably, if they were canceling those trials, then there were some negative side effects, and the negative side effects were outweighing the potential or perceived benefits as a result of the trial. Otherwise, you don't cancel it, especially given the opportunity. So that's really one of the knocks on Pfizer, and it's probably the reason that Pfizer right now is far and away the cheapest in the group. So let's just take a quick look at something else with respect to Pfizer as well. Once again, I'm going to leave this up for just a little while because I realize there are some small numbers on here, and actually I think I can I blow this up here? I might be able to. Let me see if I can just make this a little bigger. Okay. All right, so what we're looking at here are just sort of high-level financials for Pfizer, just going back a couple of years. And what you're going to see is that we had this huge ramp where revenues went up by 2.5-fold between 2019 and 2022. Why was that? I'm sure all of you know, but I'll say it nevertheless. It was the vaccines, right? So the COVID vaccines. Now, there's obviously been a significant amount of publicity about potential side effects with respect to these vaccines. I think people don't view the vaccines as sort of a long-term growth driver for Pfizer. In fact, it seems like they have completely and entirely discounted them. Now, that's actually an important point, because if I was only focusing on declining revenues and I was only focusing on those vaccines, then in the absence of anything else, I would probably not be that positive on Pfizer, because the suggestion would be the company is in fact declining. And it was not much of a growth company before the vaccine situation came into the fray, and it's been declining since. But what is interesting here is that the company is now as cheap or cheaper than it was before all of that. So the question we now have to ask ourselves with respect to Pfizer is, are we now at a point where the company has gotten cheap enough that we can just leave the vaccine story in the rearview mirror and only focus on whether and or if Pfizer could potentially, be a decent value, excluding that? And I actually would argue that I think it's priced. We talk about stocks that are priced for perfection. Pfizer is the opposite of this. Pfizer is priced as if there is nothing on the horizon which could return the company to growth. And I don't believe that that's necessarily true. It has struggled materially for some time, actually, well before the vaccines, to essentially to figure out how they were going to add new drugs, resume some sort of trajectory of growth. But the fact is, right now, it is priced as if it's going to continue to decline. And, I like that situation as a setup when some of their businesses remain intact. And that's one of the things about pharmaceutical companies, is that they do still have some relatively stable and recurring revenue. So from that perspective, I think that if you were going to start bottom fishing, trying to catch the falling knife, we can see that that's what we're looking at, that it might actually represent an opportunity. Now, what else might I look at for that? Now, I said right at the top that I'm kind of more interested at this point in trying to find bottom-up opportunities rather than momentum types of situations. So maybe I shouldn't be showing this chart, but I'm going to show it nevertheless. Let me just focus on this right here. I'm just going to highlight this purple line. Okay, so hopefully you can see that. What is that purple line? Purple line is what my good friend and longtime colleague, the chart master Carter Braxton Worth, prefers to use as the moving average. This is the 150-day moving average. And what we can see here is that, after falling below that level at the beginning of 2023 and remaining below that level for the last, we'll call it 14 plus months or so, it has finally broken out of that. So what potential tailwinds do we have here? Well, one, it's trading at 11 times earnings. It's below its pre-pandemic levels, and it appears like it might actually be breaking out above that moving average. Any bit of good news here, and I think that you could potentially see a boost. And the other side of this is that in any case, we're always looking for what Klarman called the margin of safety. And the cheaper you buy a stock, obviously, the better that margin is, because the downside is more limited. There are exceptions to this, of course. Maybe we also talked about Zoom on Monday. I think Zoom is kind of an interesting situation because They are obviously trading at an exceptionally cheap multiple, at least on a trailing basis. You know, we're talking about single digits, and their results earlier this week were actually pretty good. They beat, but they guided lower. So that was kind of the downside. But stock is, whatever, 37 to 39% cash, I think, at this point. But you have a little bit of a margin here, so I think that's kind of interesting. So the other thing to think about when you're selling puts is how expensive are the options in it. And here, maybe it's not quite as compelling. Let me get rid of some of the extra stuff that we don't really need to look at. And you didn't, or maybe you did. Let me just double check. Steve, did you mention what tenor puts you were selling? What expiration? You didn't mention that. Let's just take a look at 1 month options for now. Or maybe I'll use 2 months. Let's get so zigzaggy that it might be a little bit hard to read. Okay, so in white, what we're looking at here is the implied volatility of a 2 month option in Pfizer. And in orange is the 20-day realized volatility. So one way to think about these two lines as we look at them together is that if you're buying options, you're buying the white line, and what you get is the orange line. And the opposite's also true, right? So essentially, if I buy white, I'm selling orange. And if I'm selling white, I'm buying orange. That's kind of the way I like to think about options prices. You know, how much does a stock realize in terms of volatility relative to what the options were pricing in? In theory, when the white line is consistently higher than the orange line, then if you've been selling options, you should be seeing profits. And the inverse is also true. So here we can see that this is a slightly more difficult situation because on several occasions, we can see that actually realized volatility has been considerably higher. And let's see what those events might have been. So I just threw the earnings in here because usually you'll get those kinds of situations in, on, or around earnings. And so one of the things that tells us is that if you're thinking about selling premium, and this is true whether you are long stocks and you're selling covered calls against them, or if you are selling cash covered puts because you're interested in entering into a stock, that history does not illustrate that it's actually a really good idea to sell options into known events such as earnings. Actually, I'll just throw a quick comment out to my friend Matt Amberson. Matt Amberson does a lot of research on this. He actually runs a firm which is called Options Research and Trading. And he has done significant amounts of research on whether or not it makes sense to sell options premium going into events such as earnings. And his historical data analysis suggests that it doesn't make sense. And this chart kind of bears that out as well. So I do think that if there was a time to begin dipping one's toe into Pfizer, now is that time. They have not really announced anything positive fundamentally, but they're not priced for it either. So I feel like any good news here, and we could get some positive upside surprise. And maybe more importantly, people are just observing it as cheap because what we have seen is that it has broken out below that long-term downtrend. So generally, I like the strategy. Just make sure you time it a little bit carefully. Okay. Ranjana Gupta asks, what do you think of a June 28th, 83 Sept 2070 poor man's covered call on Western Digital, WDC? Well, for this, we're just going to pull up the OptionPlay application, and we're going to take a look at that trade specifically. So the poor man's covered call, for those of you who don't know, means that rather than buying the stock, what you do is you buy a longer dated call option and then sell shorter dated calls against it. So if, generally, and actually this is kind of an important point too. When people are referring to the poor man's covered call, they usually are referring to a diagonal, meaning that the longer dated call that you buy is going to be a lower strike, so closer to at or in the money than the ones that you are selling. And a couple of reasons for that. I'll illustrate that too. But so buying the September 70 calls, which are about $3.50 in the money, those things look like they have round numbers about $5 worth of extrinsic value. And then you are selling the June 28th, which is the month ending, 83 strike calls against it. Okay. So I like the strategy in general. A quick point, though, about this one in particular. So September expiration is only about 4 months away in round numbers, 121 days as we sit here right now. And like I said, those options have about $5 worth of extrinsic value in them. Whereas the June 28th 83 calls that you're selling have only 65 cents worth of extrinsic value. So do I think it's okay to sell the June 28th 83 strike calls against those to help offset the decay? Yeah, I do, but it's not offsetting it completely. Because you're collecting 60, even if you rode those all the way to expiration on June 28th, that is just a little over, we'll call it it's going to be about a third of the time between now and when those options expire. But you are only going to collect 65 cents, which is about 13% of the value. Now, bear in mind, of course, it is true that the decay for options accelerates as expiration approaches. So that's a mitigating factor. Another mitigating factor is that the September options will capture more events than those Junes do. In fact, the Junes don't capture any meaningful event because the most recent earnings took place on April 25th. Results were actually okay. It looks like the company did okay. But I will just quickly point out that I like to see situations where I think that the decay is going to offset or more than offset. So a way you could approach that, potentially bring the strike in 1 standard deviation to the upside. What do we get here? About $1.10 if you sold the 81s. 81s are, in round numbers, about 10%, a little more than 10% out of the money. And that would actually represent more theta or decay than you are probably going to lose on that longer dated option. So something to think about. Your profile, if you had a trade like that, would look kind of like this. And like I said, I don't see any immediate, let me just double check this. I want to see what else is on the horizon for Western Digital. Okay, so there is only one other event really that those Junes might potentially capture. Bank of America is holding their global technology conference on June 4th. And are they a presenter? So who is going to be participating in this conference? Do I see Western Digital on the list? I do. They are going to be Okay, yeah. So they're going to be participating. They are presenting at 13:40. So 1:40 in the afternoon. That's actually taking place very close to where I am. It's taking place in San Francisco. Although, I am going to be around. So maybe I'll see if I can attend that thing. So there is that. One other quick point. Let's just get back to, this is also important for everybody who is looking at any of these strategies where you're long premium. The really big catalyst for any of these is earnings. So every publicly traded company, they're going to release their earnings every 4 times a year. They announce on July 31st. That's an estimated date. So please be sure to confirm that. You always want to make sure that the dates get confirmed. So that's an estimated date. But end of July, they're going to be reporting earnings. You will get that vol crush on those Septembers. So if you want to stay in those 83s on the short side, maybe roll out to regular way July or to a 4-week weekly, a 4-week weekly option, going into earnings. That makes sense. You might even be able to sell the weekly options that capture that earnings and get some premium. But bear in mind that the instant they release those results, you're going to get a vol crush, and that's going to affect those September options. So it might make some sense to, if you're going to stay in the trade, to then also consider pushing those Septembers out. You would push those out before the July expiration took place. Okay, so hopefully that helps. Let's see here. Okay, another one from Steve Garcia. Comparing an at-the-money SPX July put spread versus a call spread of the same width, the 5300 5250 put spread versus the 5300 5350 call spread. Why is the put spread considerably cheaper than the call spread? I bought the put spread. I'm going to assume that the S&P, that SPX was on or about 5300 at the time. So two things will impact this. One is the forward. So what is the forward price of SPX, which is probably going to need to capture a little bit of carry cost, right? So if you were looking at the futures, that kind of thing, that will give you the forward. But the forward is almost certainly going to be just a little bit higher. It depends a little bit on things like dividends as well. But that's one impact. But there's another really important impact. And for this, we're going to pull up a chart because this will help illustrate it. And that is the skew. So when you were looking at July, so I'm just going to pull up July options, and we will look at actually the so regular way July, call that July 19th. Is that regular way expiration, I assume? Okay, so what are we looking at here? This is the implied volatility for July options by strike. And I don't know, again, I don't know exactly when you were looking at this, and I don't know what the forward was. But let's just assume that the forward was 5,300, so that essentially it truly was indeed at the money. When you buy a put spread, you are buying the at the money option, the 5,300s, and then you are selling, in this case, you said the 5,250s. You can see that the implied volatility for that option is considerably higher than the at-the-money option is. And so even though the premium is a function of the strike price, so the strike is lower, so all else equal, the value of an option on a lower strike is going to be smaller because mathematically you're just dealing with a smaller number. Because the implied volatility is higher, that helps offset that. And so consequently, and we call that skew, the fact that the downside puts typically have higher implied volatilities. Certainly that's true for most equities, and it's definitely true for equity indices. That is going to account for that. And then the opposite is going to be true to the upside, right? So you can see that you would be buying the 5,300 call and then selling a higher strike call option of a lower implied volatility. So even though the strike itself is higher, and the strike is one of the inputs into valuing an option, that correspondingly lower implied volatility means that the amount of premium you're collecting, all else equal, is slightly lower. And so that's one of the reasons why you will often see that the distance between the strikes is going to, the distance between the strikes, the amount of premium for the vertical spread is going to be closer to the difference between the strikes for that call spread typically than it would be for an equidistant put spread of the same tenor. And again, pay attention to the forwards, which is a function of dividends. So I can't standardize that because rates change, and the dividends that apply to any given expiration are going to be slightly different. But those are the two immediate reasons why something like that would happen. Okay, so Finwes asks, hi Mike, what method do you use to forecast the expected move in a stock or index? At the money strangles is most common, easiest to compute, but heard that the Black Scholes model can be used too. Thanks. Well, you said strangles. I'm assuming, since you said at the money, that what you actually meant you probably meant straddles. And I know you know the difference, but I make those kinds of mistakes myself all the time. I misspeak. You guys all know that. So, can you calculate an implied move by some mechanism other than taking a look at the value of the straddle? You can. It depends a little bit on what the context is. So, if you are trying to calculate an implied move associated with a specific event, that event is at some point in the future, that method actually is a bit different. You don't need a Black Scholes formula to do it, but you do need to do a little bit of math. Basically, what you have to do is you have to calculate the standard deviation for a nearer dated option and a longer dated one. And the formula typically only works if the near dated option has a higher implied volatility than the longer dated one. And essentially what you're going to do is you're going to assume an underlying sort of base level volatility, and then you can solve for the event variance. And what do I have it? You know what? I might actually have that formula handy somewhere around here. I'll post, what I'll do is I will go onto the YouTube channel. And if you could just repeat that question in the regular comment section, I will reply to it. And anybody who's interested can then just take that formula and do the calculation. But there's a couple steps. It's not hugely complicated. You'll need a spreadsheet to do it. And it's more than I can get into here and make clear. With respect to just looking out to the implied move, though, for any underlying asset between now and some future date, the straddle's a fine choice. And what you're going to find is that value is going to correspond very closely to the standard deviation for that period of time divided by the square root of 2 over pi, which is about 0.8. So what do you do? If someone says, in other words, if someone says to me, Mike, how much is the straddle for stock XYZ? All right, so we'll just say stock XYZ is a $100 stock, and how much is the straddle that expires in 90 days? And I will set my immediate response to that person is going to be, okay, well, what's the annualized standard deviation then that you're using for your assumption? And they could say, oh, it's 20. So annual volatility is 20. So if you want to adjust an annualized volatility, which is just the standard deviation for any intervening period of time, you take that number and you divide it by, and again, I apologize, it's seems mathy, it's not complicated. You get used to doing this kind of stuff in your head, by the square root of 365 over the number of days. Round numbers, 365 over 90 days. I'm just going to call that 4. For simplicity, so the square root of that is 2, which means the standard deviation is 10. I divide that number by the other thing I was talking about, which multiplies by 0.8, and that's 8%. And the value of that straddle is going to be probably close to 8%. So just so you can do these kinds of things in your head once you get used to it. But there's not really even a need to do that, because you can just go look at the value of the straddle, and it's going to be something like that. And I think that's a fine way to do it, because all of these, remember, when we do this kind of stuff, we talk about implied moves and what the options market is expecting. Is there utility? Is there value in those things? Of course there is. And could we do a calculation that is more precise than these sort of the back of the napkin calculations that we're doing here? We could. Is there utility in it, though? There is a difference between being precise in our calculations and being accurate in our predictions, right? The options market is not a crystal ball, so we obviously care a lot about what the options market is implying, We want to see instances where our own estimates might differ in some way, because we can capitalize on that. If we think the estimate's too big, then we could sell those options. If we think it's too small, then we could buy them. But it's not a perfect predictor. So, you know, it's probably part of this 80-20 rule, right? So, you know, you put the 20% of the time that you're going to spend to do the back of the napkin, it's going to get you 80% of the way there. And the utility of doing that extra bit of work is probably limited. So I think for all of us, you know, when we look at this stuff, I don't spend a whole lot of time doing it unless, you know, I'm really trying to figure out, okay, well, how do the implied moves in the future stack up to the ones we have now? And do I think there's something really wrong with the term structure? But those kinds of bets are going to be a little bit more nuanced in the in all of this. So I don't think you need to worry too much about that. They are out now. Ah, yes. Here's another one. Nice reaction in NVIDIA so far. Definitely true. Okay, so Wesley Yee, enjoying your book, you posit a hedging strategy using a 10 by 11 calendar, buys 12-month 50 delta puts and sell 3-month 20 delta puts. How would you manage this position? So yeah, this is kind of interesting. Yeah, for anybody who's watching, the book that he's referring to is the book that I published with my good friend and colleague, who's now a professor at Rutgers, Mark Guthner. So for anybody who's a student at Rutgers, maybe you can take one of his classes, although apparently some people have commented that he's a tough grader. And for those of you who have kids who are in college, I have one son who's looking at them now. Send them to Rutgers, ask them to take one of his classes. He's a thoughtful guy. So a quick important thing, yeah. When we talk about these strategies, we're trying to take advantage of the dynamics that we've talked about here. One of the dynamics that we try to take advantage of and that we are discussing there. And by the way, this is also a very important point. You know, it's one of the challenges when you write a book and you have a strategy that you rather like at the time that you write it, that you can have a paradigm or regime shifts in the way things get priced, such that a strategy that has historically worked very well may not work well in the future. I'll come up with a sort of a concrete example. And actually, we should go back to my Bloomberg screen for just a moment, because I want to go back to that skew chart. This plays into that. This skew, we consistently see this in index land. This is something new. So options, listed options in the United States, which I think began on something like 30 stocks in 1973 on what was formerly called the Chicago Board Options Exchange, a spin out of the Board of Trade, and they listed puts, I think it was 76 or 77, somewhere in that time frame. It's probably 77, because another friend of mine and former colleague, a guy named Neil Glassman, after he got his master's degree at Chicago, they used to trade puts synthetically. So you could buy a put synthetically. They would basically issue them, and they would buy, call, short stock, and create puts synthetically. Up until the crash in 1987, this skew, implied volatility, where the puts are bid well over the calls, that didn't actually exist. Before then, people took the Black Scholes idea, and I say the Black Scholes idea because the Black Scholes formula itself, which was Fisher Black and Myron Scholes, they came up with this. There are other formulas which we kind of classify as Black Scholes models, but they're not all Black Scholes models. But that is a closed form solution. You just put some numbers in, the price of the underlying, a dividend yield, because that first formula didn't actually use discrete dividends, rates, volatility assumptions, and you got a price. And it was, a watershed in finance. There's actually a really interesting documentary. I think they call it the $1 trillion equation or something, but it basically is about what happened there. So the regime shift I'm talking about is that after the crash in 1987, it became understood by practitioners that, wait a minute, calls and puts, they shouldn't use the same implied volatility assumption. Remember that the model was basically taking a heat transfer equation from physics and saying, okay, this is a good way to think about how the value of an option should relate to the price of the underlying and relate to time and relate to how volatile the underlying asset is. But there are flaws with making simplified assumptions about how things behave. For example, it didn't really accommodate things like price jumps. You know, the fact that prices can gap and that continuous hedging isn't possible. And then, of course, there's excess demand for puts over calls and so on. So anyway, you can get these regime shifts. So in the book, when we were talking about selling near-dated options, call it the 20 delta options, and buying these longer-dated ones, we were trying to take advantage of a couple of dynamics. These things actually still remain true, but just bear in mind that it could change. The dynamic we were trying to take advantage of is that there is a bit of a volatility risk premium that typically exists in index land and to the downside puts in particular. And we can attribute this, well, we don't have to attribute it to anything in particular, but we can make assumptions about why this is true. One of the assumptions we could make is that there is demand for insurance. People want to insure their portfolios, and that creates demand for downside puts that exceeds the demand for upside calls. So that would be one rationale. The other is this jump risk thing that I was just talking about. So another quick point I would make is that how attractive that trade is also depends on the term structure. So if you're buying longer dated options, one of the things you hope is that you're not going to pay a much higher implied volatility for the longer dated option than you're going to collect for the shorter dated one that you sell. So here we can see that there is some upward slope to the term structure. So those longer dated options do have a higher implied volatility. And as time passes, you're not just going to give up decay, the implied volatility will fall. So that decay rate for that longer dated option is going to be slightly higher than you thought. It would be if all you did was just take that single volatility assumption. But, and I'm going to just show you here, we can just go to I'm going to just choose a different option. So if I choose a lower strike option like the 52.15s, so if I'm buying a longer dated option, so I go out to September of 2024 and I buy an at the money put, and then I sell a lower strike put, you can see that the implied volatility of those two options is actually, and let me draw a line so we can actually see this a little bit better. The implied volatility of the option that I'm selling versus the one that I'm buying, there's a little bit more of a relationship there. So that helps offset that. You know, these are things that all play into it. But bear in mind that if all of a sudden, you have a huge market shift and people say, wait a minute, we've been thinking about the way we price options all wrong, you will see these dynamics change. That has happened in numerous cases. And it's happened in both directions. There's a book that I read recently by Klarman called Margin of Safety, and we all talk about margins of safety all the time. And in it, he talked about the high yield bond business. I'm going to go to another question here while I bring this up. And he pointed out that before Mike Milken and Drexel and the gang sort of really got the junk bond business going, that they did some work, that Michael Milken had done some academic work, I think when he was at Penn, where he pointed out that a diversified portfolio of junk bonds, of high yield bonds, actually had better risk-adjusted rates of return than investment-grade bonds because number one, the default risk was overstated, and the diversification of having this group of bonds helped offset some of the higher default risk that you would have relative to investment-grade bonds. And so therefore, it made sense for people to invest in diversified portfolios of junk bonds. Well, of course, looking at the historical data, that was true. But what they did with that data was they said, okay, well, they created a huge market and huge demand for junk bonds because people said they could, I can get better risk-adjusted returns. And what they started issuing new junk bonds. And the problem was that the risk-reward relationship of these new ones didn't look like the old ones did. You lost some of the capital appreciation potential that some of the other ones did. So if you bought a diversified portfolio, some of those bonds you were buying, you're buying them 50 cents on the dollar. And so if they didn't default, you could have a massive win. And of course, the demand for junk essentially meant that supply was going to be brought in to meet it. And so all of a sudden you had all kinds of, crappy issuers who were bringing out all this crappy paper, and the default risks now were understated rather than overstated. So, the market creates situations where you have a positive dynamic, but just its own existence can actually invert that relationship. And that's actually what happened in the junk bond business, and it could happen in vols. So you just keep an eye on vols and say, okay, if you start to see pronounced shifts in the way you expect to see things, bear in mind that can have an impact. Would Viking, is that what this is? I think, what is this? Yeah, we were talking about this one before, I think. Yeah, so Viking Therapeutics be an acquisition target for Pfizer or others. That has been discussed, actually, hasn't it? So I think any one of, that's one of the things that has to happen, is that when you have the legacy pharma companies, if they are unable to develop new drugs of their own, the alternative, and the one that often takes place, is they need to buy, right? So that's basically the whole play in the biotech space, which is that scientists are coming up with new therapies, with new pharmacological solutions, and if they really feel like they have promise, they raise money, they try to develop them on their own with the hopes, I think, that they do get acquired. So certainly a possibility, but as we can see from the chart here, some of that is a bit priced in, into it already. So I would expect a Pfizer and others, by the way, so we include the Amgens and people like that. They're going to be out looking. So 6% dividend. So speaking of Pfizer, 6% dividend yield is attractive, and slow growth is enticing and safe. Okay, yeah. So the thing that's really safe, I'm really glad you followed up with that, Steve, because one of the most important things to think about, this is true whether you're looking at selling options or whether you are looking at buying stocks with yield as the objective. I have seen and heard of people going out and saying, I look for stocks to buy that have expensive options so I can sell covered calls, or I go out and try to sell cash covered puts on stocks that have very high implied volatility because they're chasing the yield. Simply chasing yield is a very dangerous thing to do. Generally speaking, there is a reason why options premiums are elevated. And if they're elevated, think about this. Not only is there a reason, but the more complicated the dynamics for a business are, and the thing that might be contributing to that volatility might be that there may be better places in the cap structure to play than by being the first loss. So when you sell puts on equity is subordinate to all of the credit. And if you sell puts on equity, essentially you're the first loss. So just bear that in mind, that when you sell options premium, so that I'm just talking about the yield chase and this as a general concept. And so there's a similar dynamic that exists when people are chasing dividend yields, where they go out and they try to find stocks that have the highest dividend yield. That too can be dangerous, simply because a very high dividend yield could suggest that the options market, in part, but equity traders generally, don't believe that the dividend can persist. So the very first thing you want to do in those cases is take a look at what we're looking at here, which is the company's free cash flow. Does the free cash flow sustain the dividend? Because if it does not sustain the dividend, if they continue to pay it, effectively your own capital is simply being returned to you in some way, or it's eventually going to get cut, or the underlying equity is just going to get more risky. Why? Because, I mean, if they are not generating sufficient free cash, the only things they're going to be able to do eventually are, what, issue debt, presumably. And so that means that you're essentially going to have, that additional risk. In this case, though, Pfizer is generating net free cash. And actually that free cash flow is expected to grow. So it does appear, for the time being at least, that the dividend is well covered. So that's an important thing to look at. If you're buying stocks for dividends and the yield is suspiciously high, the first thing you want to make sure is that net of the dividend payments, that they have good free cash flow, and that free cash flow looks sustainable. Because if it isn't, the dividend's probably not going to last. But in Pfizer's case, it looks like it's well covered, so I don't think that's going to be an issue. Raimoka says, Bidu, near the near-term bottom. Right? Question mark? Oops. So it's interesting. I'm not crazy about trading Chinese stocks in general, largely because I'm just always concerned about two things. I'm concerned about what the Chinese government can do, will do, has done. So that's the first thing. And the second thing is I've always treated some of the accounting practices with a little bit of skepticism. That said, there are a couple of companies whose valuations do tempt me. This is one. Baba has been the other. Although it was interesting when Baba announced their results, when you took a look, net of taxes and everything else, at what ultimately ended up in the hands of the shareholders, you began to recognize that there are a lot of hands out before the equity folks get their money. That said, we are getting fairly close to that level. So things that, and this is not my insight, by the way, I don't want to take credit for this because I'm not a chartist, but if I'm thinking about momentum or things bottoming out, I will try to take a look for, a stock to meaningfully get above a downtrend. We aren't quite there yet in Bidu's case, as we can see here. But we're close. We got above the 150 right in here, but that looked like it was a little bit, I'm not sure if it was a fake out or not. It definitely would appear, though, that, we get down to these levels in here, and we're probably, ready to back up the truck, assuming that there's no material impairment of other types. And what I'm really talking about is what's going on over there. So a better value than it was, certainly. Has it convincingly gotten into that territory? That doesn't appear to be the case to my eye, at least. We'll just take a look at a couple other technical indicators and see what those have to say as well. So now I'm just taking a look at those that have been most successful over the course of the last year. So these things in green, this shows how profitable these technical approaches have been over the course of the last year. If the arrows over here are pointing up, that means the strategy is long. If it's pointing down, it means it is bearish. All of the profitable technical indicators over the past year in Bidu are similarly not bullish yet. They are all still pointing down, and they're all profitable at this point. So my 2 cents, look, I'm not a technical analyst, I'm not a chartist, but I'd much rather miss the first 10% of a meaningful rebound than try to, bottom ticket and be the guy that got, be the first one in. Let other people lead the way a little bit. That's kind of my 2 cents on it. Particularly if you're trying to call a bottom in something. My 2 cents on that one. Okay, Ali asks, I've heard that with the growth of AI, data centers will require substantial additional power. Natural gas, is this a good time to increase investments in companies like Exxon and Chevron. Interesting. So that's an interesting take, Ali, I have to say. Most folks, so number one, absolutely. Okay, so in terms of the broader theme, there's little doubt that this is true. And I know we're closing in on an hour, so for those of you who are sticking around, but I have a couple more minutes, and I'm hoping that my colleagues that are in my ear also do. Most people are playing that actually with power generation rather than Exxon and Chevron. And I think the reason for this is that the expectation is that and I think I see where you're coming from, which is that incremental power demand, because they spool up more quickly, generally speaking, is natural gas generation, right? And it's also, it's not subject, as renewable sources can be and often are, to fickle weather conditions. So it's an interesting, I haven't heard a lot of people talk about playing the integrateds as a way to meet the power demands of data centers. I think a better way to play that would be with utilities themselves. But it's an interesting approach. I might try to make a more specialized local natural gas play, though, rather than playing the big integrateds on that one. But that's an interesting idea. Actually, I also don't think that those companies are extremely expensive here, so it's probably okay to be in them anyhow. But I like where your head's at. That's interesting. Is there a better time of day to enter the position when working the London or New York session? Does it make any difference? For U.S. listed stocks, I like to trade them regular way during the trading day. I've just generally found it always seems like there's somebody who's got more information than I do when I trade U.S. listed securities outside of U.S. trading hours. So I'm trying to remember the time that, well, I do remember the time. So back in, was it late 90s, 2000-ish? Yeah, it was right when the SEC announced that they were investigating accounting irregularities at Tyco. And this was after David Tice's prudent bear fund had made a bearish bet on the stock, probably about 6 months earlier. Tyco was trading 36 and change pre-open, and I saw it tick down to 22 on the Instinet machine. That was when Instinets used to be a dedicated machine before it opened at 26 and change that morning. So there was an opportunity to buy it at a level well below the opening print on the big board. But I traded a lot of stock that morning. I think we bought about 50,000 shares of the stock, and I think we bought it at an average price of about $30 or 29 and a half. I don't like to trade outside of regular trading hours. I always feel like somebody else has got more of an edge than I do. I'd rather just trade the opening or the closing print. That's just me. If you have unique insights, of course, be my guest. How and when, and Neil asks, how and when do you manage diagonal put debit spreads in general and specifically SPY currently in negative, or wait until expiry of the near month? Would love to hear your comments. Thanks. I've talked about this a little bit in the past. Part of this has to do with deltas. So I'm always looking at whether I might want to manipulate an option when I get up to about that 60 delta level. So if I'm buying, say, a 45, 50 delta option, and it starts to migrate into the money as it rolls down, so I'm talking about the longer dated in that SPX diagonal that we were talking about earlier, probably roll that strike down and the other one down at the same time because I'm trying to maintain that same relationship. I'm also looking at the theta relationship. I want to make sure I'm getting a positive theta there. So yeah, things that we look for there. Thanks for the white screen. Helps so much for visibility. Sometimes it's going to be light, sometimes it's going to be dark. I can actually change the color of the screens on the Bloomberg terminal, but it takes some doing, and I'm just used to looking at it like this. So when I share that screen, it's probably going to be dark. When I share the OptionPlay screen, it'll be light. And Fred, all of theirs are light, I think. Okay, so FinWest. Oh yeah, FinWest confirmed. He was one of the ones that put out that earlier inquiry. He was talking about straddles rather than strangles, which I was pretty sure. Black Video, isn't the expected move really the expected range? Isn't the expected move really the expected range? Yeah, no, I wouldn't think about it that way. Standard deviation gives us ranges. So one standard deviation, 70% of the outcomes are going to fall within that range. One standard, and by the way, it's 68%, but it's going to be so one standard deviation is going to be 70, and then 2, you're going to be up in your 90 plus, and then 3, 99. Right, so 3 standard deviations is going to encapsulate 99% of events. So those are the ranges, and you realize you're going to fall inside of that. The expected move is really a different way of saying, from a statistical point of view, what in statistics would be referred to as the mean absolute deviation. So is that the expected rate? The mean absolute deviation is an average, means an average, right? So I guess the expected average move, how about that? We're sort of splitting hairs and getting semantic, but when we talk about ranges, we're usually talking about probabilities that we live inside of a certain range, but the nature of where and how we fall in that is also important. So if you imagine that you know that the standard deviation of something is 1, and then you also know that the average move is 0.8, because that's what we're talking about. So if the standard deviation is 1 for a normal distribution, and the mean absolute deviation is going to be 0.8. So I think both numbers are important, but they're not the same number. Do any trading platforms let us filter and scan for implied volatility and historical volatility relationships, such as implied volatility is greater than HV? Well, yeah. I mean, I guess, first of all, you can get that data from a lot of different sources. So, I pull this out, I can put it into a spreadsheet, and I can screen for those types of things. We could pick anything here. We can look for that kind of stuff. But don't forget that just because you should probably just make sure that you match your events in history. And the reason I say that is because remember that when you're calculating realized volatility, you could do this yourself. Like, you get the closing price, or you get the open, high, low, close, and you calculate what the realized volatility is. Remember, that's looking backwards, right? That's what the stock has done, and the options markets are looking forward. What will it do? And if you have an event in the next 30 days, so let's say earnings happens in the next 30 days. Well, we know they only report 4 times a year. If it happens in the next 30, it did not happen in the last 30. So the last 30 is not going to incorporate an event that the next 30 does. And the opposite's also true. If I just had earnings, I could have had a lot of volatility. So make that adjustment when you do that work. But yeah. As somebody in my ear just pointed out, ORATS probably has that data. And look, if you can actually sort of see these things too. I mean, we just pull up on if you look at OptionPlay or anything else, you're going to get your implied volatility data. And let's see here. Okay, and then finally, news just out: U.S. in talks with Pfizer and Moderna regarding avian flu vaccines. Yeah, I'm sure they're going to have no shortage of angles to play in the vaccine space. And that's dandy. This is something that Dorothy was pointing out. But I will tell you that where these companies are concerned, I would really, really like to see them doing something outside of vaccines. And, right now, the demand, the opportunity, the health crisis, the thing that we really need are the obesity and diabetes drugs and treatments. So I think that represents a great opportunity, and I know they are pursuing it. So if they get something in that area, that's going to be the real potential short-term hockey stick for that. Okay, hour and 15 minutes plus. You guys are very patient, those of you who have hung around as long as you have, and I appreciate your time and attention. And I hope you all will like, subscribe, share, tell your friends, all that kind of good stuff. And I also hope that you will join me next week on Monday at 4:15 when we do this again. Thanks for watching.